You can now purchase a property with a 5% mortgage. In the 2021 budget, the government announced a 95% mortgage guarantee scheme. In this video, I want to explain what it is, how it works, and how you could benefit from it. Watching my videos for the first time, my name is Hussain, and on this channel I share with you my 15 years of property investing experience to ultimately help you get further faster in your property investing journey. 95% mortgages, these are something that have been around for a little while. However, over the last year we noticed they started to disappear at different times, and this is really because some lenders are becoming uncertain and not confident in what was going on in the marketplace. They were concerned that prices might fall, so they start reducing their loan to value mortgages. The loan to value being a level of debt versus the purchase price. However, what the government wants to do, Boris particularly over the last years announced, he wants to try and encourage generation rent. People have been renting for a very long time to move into home ownership. And this is what the drive is for these 95% mortgages. However, to encourage the lenders, what the government is doing is saying, hey, look, if you lend these high loan to value mortgages, we'll guarantee the top slice of that, so you're not taking all the risk. In essence, that's essentially what they're doing. 95% mortgages are not a new phenomenon. In fact, if you roll the clock back to 2008, you'll find there were a number of lenders doing high loan to value mortgages. And you could even get 100% mortgages. In fact, there was one lender in particular, Northern Rock, which if you remember, they're the ones that caused some of the major problems at that time. And it wasn't just this bank alone that was causing the problem, but many banks were doing this, but particularly Northern Rock. What they would do, they'd give you all the money that you need, i.e. 100%, plus then some. How does that work? They'd give you more than 100% of the purchase price. So this was the kind of things that were happening at that time. Now, clearly, the government doesn't want this kind of reckless lending to happen again. So they're much more cautious in terms of how they put this scheme together. And essentially what they're saying to the lenders is, hey, you do your normal lending criteria up to 90%, and from 91 to 95%, the government will guarantee that top slice effectively. So the bank is still taking some risk. They're not being reckless in terms of how they're lending money, so they don't fall into the same mess that they did in the last credit crunch. As you can see from this graph, in 2007, there were over 795% mortgage products available in the marketplace. But when the crash happened, they pretty much plummeted down to zero. But then slowly over time, as the confidence built in the market, some of these products started to come back. Now, they were nowhere near the levels they were before. But then in 2020, when COVID happened and the market started slowing down, there was uncertainty in the market. Again, the number of products plummeted. So the government is really trying to drive the market forward. Why is the government doing this right now, you might be wondering? Well, if you've seen any of my other videos, and some of these will link up in the description below, you'll know that I've explained that the government is really propping up the market right now. It's propping up the property market, it's pushing it forward. It's got a number of things in place, like the stamp duty holiday, for example, that's really pushing and driving the property market because it's such a big contributor to the economy, and this is one way for the government to bring the economy back. The government mortgage help to buy scheme is not a new concept. There's been many versions of this scheme around. In fact, this property we're in now, this is one of my new build projects, and we've already sold properties on this site using the older help to buy scheme. However, the new one is different because it's not only focused on new build properties like this one as we're in, but also it could be properties that are already on the market, i.e. second-hand, third-hand properties. They don't have to be brand new build, and this is a key factor difference between the new help to buy scheme. The government has said these new products are going to be available in April 21, and at the time the government announced this, you already had a number of banks on board ready to go with this scheme. So the likes of Lloyds, Barclays, NatWest, Santander, they're all good to go, and there's other banks interested in doing this as well. The key benefit of that is that there's a number of products going to be available, so the market will be competitive rather than being limited to one particular lender, say that's the only one doing it, and you haven't got much competition in the marketplace. If the main lenders are on board and there's other lenders coming to the market with these products, it'll just mean that the mortgage market is going to be more competitive and you'll be able to get a better quality product. Also, the other thing the government has said that their lenders need to be able to provide a 5-year fixed mortgage term. What that means is that you can fix your rate for 5 years. Now, one of the key benefits of that is it gives you certainty. It means you can go to plan and budget, and you know how much you need to pay each month, regardless of what happens to the interest rates when they start fluctuating and moving. And look, let's face it, interest rates are the lowest that they've ever been on record. and at some point they're going to start going up, and that's going to impact the rates that people are paying on their mortgages. So with them being fixed for 5 years, or you having a choice that you can fix your product for 5 years, it means you're probably locking in some of the lowest rates that's ever seen in mortgage products. If you're enjoying this content, make sure you smash that like button and subscribe to the channel. That way you'll get to see more videos just like this one. What I'd like to know is, what are your thoughts on this new 95% government scheme? Is it something you think you'd be able to benefit from? I'd love to know. Pop it in the comment section below. It all sounds so rosy, so let's look at some of the criteria that the government has released. One of the things that they've said is, to be eligible for the scheme, the mortgage products you're applying for need to be higher than 91%, i.e. 91 to 95% in terms of range, to be eligible for this particular scheme. Also, the value of the property can be up to £600,000, which is great because typically house prices on average are around £250,000. So £600,000 is great news for those people that are in the southeast, down near London, where prices are much higher. You can apply for this scheme not only if you're a first-time buyer, but also if you're a mover, as long as it's only the one property that you have, so it's not eligible for second properties. Unfortunately, it means as property investors, we can't access this particular product, and if you're purchasing a company, you can't also access product either. However, if you're looking to get started in property and you're looking to get onto the property ladder as a property investor, then make sure you watch all the way to the end, because I have a little bonus for you in terms of how you can use this to make it work for you. One of the key advantages of this scheme is really about being able to get onto the property ladder with a very low deposit, which is great news if you're stuck in the generation rent environment where you're renting, you can't really afford to be able to save up for a deposit, a sizable deposit to be able to buy. But only having a 5% deposit means you can get onto the property ladder. However, affordability is still a key thing. So it's not simply a case of you can get onto the property ladder with a small deposit, but the affordability criteria means you need to be able to afford to be able to service the mortgage payments. This is a key difference. So what happened pre-credit crunch in 2008, the market crashed at that time, but the lending that was happening prior to then, it meant that you could get into property with very little money, i.e. 95%, 100 or even more than 100% mortgage. And also they turned a blind eye to a lot of the lending criteria about around affordability, so that people were getting onto the mortgage ladder that really shouldn't have been purchasing property at that moment in time. The other thing that's different to the Help to Buy scheme as well, compared to the current one, to what was existing previously. So on this site, as I mentioned, we've already sold property on the other Help to Buy scheme. But what it means is, when you're buying on that scheme, the government has an interest in the equity that you have in the property. So they're just not lending you the money, they effectively have a portion of the property. As it goes up in value, their interest goes up in value, i.e. the amount that they own goes up as well. So eventually when you come to sell or remortgage and you pay off what you owe on that loan, it will be more than what you initially had as a loan, if that makes sense. So effectively they're benefiting from the increase in value. However, on this scheme, it's your property, you own all of it, other than the debt that you've got, of course, with the bank. So that means any uplift in value, you are going to benefit from all of that. Let's now look at an example. Let's say you were purchasing property for £250,000 and you're putting down a 5% deposit. So that would be £12,500, which means you're borrowing £237,500, i.e. 95% in terms of your mortgage. Now, when it comes to affordability, it means that 4.5 times your income, or your combined income if you're buying with a partner, needs to equate to that £237,500. Effectively, what that means is your combined salaries would be in the region of about £52,000 or maybe £26,000 each, so that you can reach that affordability criteria. So that's just a typical example in terms of how those numbers would look. Your monthly mortgage payments at, say, an interest rate of 4%, now the interest rates might vary, they'll be at 4%, you'll have about £1,250 a month as a repayment mortgage. Now, the government has said that these 95% mortgages need to be on a repayment basis. You can't have them on an interest-only basis. And essentially, if you want to learn more about that, then make sure you link up here to the video that we'll put up here, which explains the difference between interest-only and repayment mortgages and how they work. If it was the interest element only that you were paying, you'd probably be paying less than £800 a month on the interest part. The rest of it is capital. Essentially what that means is you're paying 4% of the debt as interest, the rest of it you're paying a little bit each month to pay down the debt over time. The example is over a 25-year mortgage, But remember, I'm not a mortgage advisor. I can't give you any financial advice. What I'm really doing is sharing my knowledge and experience with you in the way of education to help you understand how this scheme works so you can reach out to a great, competent, independent mortgage broker who can help you get onto the right mortgage product in terms of your purchase. And if you need a referral, a recommendation for a broker, just reach out, ping me a message, whether it's on Facebook, LinkedIn or Instagram, and I'll try and connect you with somebody who can help you with that. The other advantage is when you're buying it this way, you haven't got the stamp duty that you'll be paying either, at least for the next few months if you're utilising this scheme. That means if you're purchasing up to £250,000 in the next few months, there's no stamp duty to pay. And often for most first-time buyers, because they're buying at a lower price, they tend to not have any stamp duty anyway. So as you can see, this is a great way that the government is really trying to push people to get onto the property ladder and start moving out of a rental environment to starting to have ownership in property. With high loan to value mortgages, the lender is taking often more risk. So what that means is they tend to reflect it in the interest rates that they will charge you. So the less money you're putting down, the more risk the bank is taking, the higher the interest rate often is. So this is something also to be mindful of as well. So when you're shopping around trying to get a competitive rate, and generally speaking, they're going to want you to have a perfect credit score. Perfect credit score being that you don't have any adverse, in the sense that you don't have any CCJs, you don't have any late payments, or you don't have any recent history of problematic payments. So it's important to check your credit file. If you're interested in learning more about your credit file, then make sure you click on this video up here where you can see how your credit file works, how you can access it, and how you can improve it as well. So if you've got any issues with a credit file, then you might find that this may not work for you. So assuming you've got a good credit file, another challenge that could exist is if you're self-employed. If you're self-employed, normally the lenders will ask you for the last couple of years of income so they can kind of work out what you can afford. But of course, there's been a pandemic. Many people haven't been working normal hours. So how is that going to work? That might cause a problem as well. This is why it's really important to sit down with a good broker who's going to be able to help you and point you in the right direction. It sounds fantastic and an exciting time to be able to jump onto the property ladder and get moving, right? So what are some of the things that you need to be aware of if you are looking to do this? Well, one of the first things is that you're probably not alone in thinking about maybe now's the time to buy a property. There'll be other people looking to do the same thing, and essentially what that will mean, there'll be many more people chasing the same properties. The amount of stock or availability of property on the market may not be very much. And what will happen, this will drive up the prices. So not only you will have competition from other people in terms of trying to get on and buy a property, but you'll probably find house prices will start shifting upwards as well. Another thing to be mindful of is interest rates at the lowest that they've ever been. And as I mentioned earlier on, that's fantastic, that's great news for you, but at some point they are going to start to rise and you need to understand the impact they might have on your mortgage. So for instance, the example we had earlier on the £237,500 mortgage on that 95% mortgage example I gave, let's say the interest rates rose by about 3% and this took it to say 7% rather than 4%. What that would mean is your mortgage payments would rise by more than £400 each month. It's important to assess how much it is that you're going to be able to afford and effectively stress test your affordability. Something else to be aware of is none of us really have a crystal ball. We don't know if house prices are actually going to rise or the property market's going to start falling. But if it did start to fall, which could happen, that could mean that you could be negative equity much quicker with a high loan to value mortgage. What do I mean by that? Well, let's say you have a property that's £100,000 and you borrowed £95,000 from the bank. So you've got a £95,000 mortgage on a £100,000 property. Well, let's say the market drops and it slows down and there's a drop of say 10%. The new value of that property is now £90,000. However, your mortgage debt is still £95,000, which ultimately means you could be £5,000 in negative equity. Now, it's unlikely, but as I said, none of us have a crystal ball, so it's important just to be aware of these things. As a thank you to watching so far, I've got a little bonus for you, particularly if you are new to property and you're looking to get onto the property ladder. Now, as I mentioned earlier on, this scheme really isn't for property investors. However, if you don't own property, you could get onto the property ladder using this scheme. If I was in, let's say much younger than I am now, and I didn't have these grey hairs, what I would probably do if I hadn't already purchased a property, I would be looking to purchase my first property using this scheme. So I'm putting down a small deposit, I'm purchasing a 95% mortgage, but then I'd be looking to add value to the property. So I'd be looking for a type of property which I can increase its value on. And then the other thing I would look to do is once I've done that is also see if I can rent one of the rooms out, a rent a room scheme, which means that now I can also create an income by having a lodger at the property, as well as appreciating or forcing up that value of the property by improving it. That means it's a double win. I'm getting some income off it. I've increased the capital value. So whenever I come to sell in 1 year, 2 years, 5 years, whatever it might be, now I've got a profit from that property and I've had some income as well. Now that profit might simply just roll into the next property, or it might be I've taken it as a profit. Each and every month I do several videos to ultimately help you in your property journey. If you'd like to see specific type of content, make sure you pop it in the comment section below so that I understand what it is you're looking for, and I can try and tailor this content really to suit you and help you. And what I've got lined up next for you is a fantastic video which I know you're going to enjoy, which is just up here. But just before you click on that to watch that, make sure you give my face a little click down here, and that way you'll be subscribed to the channel. So go on, click on down here on my face to subscribe. If you haven't already, then go and enjoy this video over here.